Welcome to Outside the Box Financials, where we think differently for a better tomorrow. So, in this video, I wanted to show y'all how we can use a whole life policy to fund a Forex account, which is the Forex exchange, and to generate more income and exponentially increase our wealth. Right now, before I go in, I put it all throughout this video. The Forex is extremely risky. I just want to push that out there. Right, so be cognizant of if you do choose to use it, because you can lose more than what you put in. But this is for educational purposes, entertainment. So let's get through it and see if this is suit for all y'all. All right, let's go. So use a whole life policy. So even if you lose money, you still have the money in your policy and never lose it. It will continue to collect uninterrupted interest, grows tax free as long as it doesn't MAC, and there's other additional benefits like the death gratuity, and life settlement, and so on. But again, the whole life policy is the bread and butter, and it's the structure that needs to be in place, or the foundation, along with your mindset, that needs to be there for everything else for you to build upon, so you can increase your wealth and also be protected. All right, foreign exchange market, which is called the Forex. So you can move large amount of money with small funds, which is the 50-to-1 ratio. That means if you have $1,000, you can trade up to $50,000. Right? So just off of that, you can hear how you can lose a lot of money very quickly. This is not for the faint of heart, and it takes a lot of control of your emotions and extreme risk management. All right, I've been doing the Forex stuff for about since 2012, so what is that, 11 years? So for some that come in, they might be able to gain a lot of money very quickly, but the thing is, if you don't develop good habits, you can lose your money very quickly too. Don't go with the stuff you see on Instagram and Facebook and all that, which shows the luxurious lifestyle. Don't be one of those people that see that and then all of a sudden you think, oh, I could just dump a whole bunch of money, and then you lose your life savings, and then your wife leaves you, your spouse leaves you, your dog leaves you, the car leaves you, the grass stops growing because you did something dumb. Don't let that be you. Manage your stuff. It can generate income if done correctly. I'll go through here in this video. This video is mainly just to show you what can be done. It doesn't give you the actual tools and tips and how to do it and really go in depth. That's for another video. I just wanted to show y'all. Alright, it's a great tool to use to exponentially increase growth. Highly volatile depending on what pair you use. Highly risky if you don't know what you're doing. Through some of these slides, we'll go over some of the terms so that way y'all understand a little bit. Alright, so what we got is a whole life. Again, that's the foundation what we want to build off of. Then we borrow from it. Then we put it into a bank. Then we get a Forex broker, right? Then we fund our account. We open the position. And then you sit and wait. And voila, there comes all the money. Is it that simple? No. Right? The whole life, the $10,000 still in cash collecting interest. So even if you did lose that $10,000 is still in the whole life as if you never touched, and still collecting interest. That's why that's like bread and butter, right? Because you're still collecting interest off of that money you earn probably through your work or whatever, and it's still in there, right? Making money. And then fund an account, like my broker, what it does is, I think with the unused margin, the unused funds I have in there, it gives me, I think, 3% interest or somewhere around there. So even if I don't use it, well, I have to use the money for a trade. But say I trade, I don't know, $1,000 off the 10,000, that 9,000 will collect interest. So at least it's gaining some money and then gaining money on the position I have on. So crazy. All right, Forex. Some of the terms is currencies is basically dollar, euro, yen, florin, zloty, ruble, so on. Okay, margin is basically just leverage. pip is 0.001 of a cent, right? So 3 zeros. Rollover interest is interest rate differential. So basically what it is if you hold a position overnight, you depend on the interest rate between the different countries' central banks. You either get some money from it or you won't get no money from it. Best way I could describe it for now. The pair is basically two currencies that are being traded against each other. So you got the euro against the dollar, the Japanese yen against the dollar, and so on. Spread is the difference between the sell and buy price. So when you want to get into a pair, you have to buy. When you get into a pair, you have to buy at the ask price. When you sell out of a pair, you have to sell at the bid price. So the difference between that is the spread. And so people have strategies so they can make money off of that. All right, commissions, what it costs to enter a trade. So the broker I use, basically I just pay the spread. I don't pay commissions. But some places you pay for commission, like in stocks you'll pay for commission. You'll pay the spread and commission. And that's why I like my broker. All right, market limit stop is just basically type of orders. Market is you just get right in, you purchase it, and that's what you, and the price you see is the price you get. Well, sometimes depending on slippage, and slippage I don't have it on here, but it's the term of when you want to buy at $1, but you buy in at $1.02, the slippage is 2 cents. Right? And limited stop is just instead of you just getting right into a position, you can select the price you want to get in. Right? And sizes, you got nano, micro, mini, and standard lot. Right? So nano, micro, mini lot, we'll go over that in a little bit. Short is basically the direction of the position you take and the move of the market. So if you get in and you think price is going to increase, that's going long. If you think price is going to decrease, that's a short. Of course, you can go both ways. But explaining shorts is another video amongst itself. Right. So the Euro Hub, that's what we're going to be looking at. Margin utilization is about 5%. And this is one of the tools that I use because if used correctly, you can make a lot of money off the rollover interest. Right, so right here we got a nano lot, which is 100 units, which is the trade value is 108. So since margin utilization is about 5%, 108 times 5% is $6. About $6 in margin that's utilized. All right, then we got a nano micro lot, 1,000 units. Trading value is 1088. Margin is about $54. Right, every pip again is 0.0001. It's 3 cents. So if it moves up 1 pip, you gain 3 cents. Right, but it'll take $54 to be able to trade 1,000 units. Then we got a lot size of 10,000 units, which is a mini lot. 10,883. Margin is 544. And then we got a standard lot at 100,000 units, which is 108,834. Which the margin cost to get into this position, it's 5,441. So if you have 5,441, see how you can trade a decent size? And if you have $10,000, you can trade a little bit more than that. So that's what I'm saying. You can move a lot with a small amount of money. So be careful out there. All right, what we got now? So here on the left side, we got the financing charges for the rollover interest of negative and positive. And this is what I showed y'all on the right side of how it looks like when I want to place an order and put in my positions. So we're going to go over this a little bit and show what the gains and the gains are. I don't know. My mind is slipping because I got to go to work in a little bit. But moving on. Don't know why I said that, but moving on. All right, so what we got here is we got the sell annualized. Well, we got the sell right here on the left side. Right, the annualized rate is at 8.4% gain. which is a decent amount, right? Estimated gain is about $25 per day for a standard lot. Again, the standard lot is $5,443. So in order to be able to earn this, you have to use that amount to get into the position, and also price fluctuates, so you got to be cognizant about that. But at 8.4% gain at $25 per day for a standard lot, right here you can see that it's $9,124 a year that you'll gain. So $25 times 365 is $9,125. And the trading value of this is $108,834. This is up $10. I mean, $10,000. Man, imagine $10, but $10,000. The trading value, again, is $108,834. We got margin at 5%, so the funds needed, again, is $5,441. But what is the actual gain? 167%. Why is that? Because in order to move that amount, we're only using 5,441. So that 9,125 well exceeds the 5,441. And see how you can gain a lot of money from here? But we'll go over a little bit more in the preceding slides. And then again, additional gain if price drops, which means you can collect money off the rollover, and you can collect money off, right, the drop in price. It's sort of similar to like stocks. If you buy into, say, a stock like, was it 4G or one of those stocks that give dividends, if price goes up, you earn, and you earn also when they release a dividend. It's similar. Not the same, but similar. All right. So risk, potential to lose more than you put in. Yes, be cognizant about that. You can lose more than you put in. In 2015, the Swiss franc, the Swiss National Bank removed its peg. Again, its peg on the euro, and price appreciated for the franc significantly, causing that the broker I previously was in to go bankrupt. Well, it's U.S. entity to go bankrupt. So be cognizant. Also, they were good about not charging the traders and so on. They just wrote it off. But still, be cognizant about that. Equals more than you put in. If you have your life savings $200,000, don't go crazy. Okay. Margin call. Basic margin call is if your account drops too much, they'll tell you to put some money in. Never meet a margin call, but they'll tell you to put more money in so you can keep the position open. Never meet the margin call. If you ever hit a margin call, just exit, because you're definitely on the wrong side, or you're not doing something correctly, or both. Going YOLO, I think you can. Again, if you have that $200,000 in retirement and you decide to go YOLO because you saw these Dogecoin people and think you could do it in Forex, do not do it. Do not do it. Do not do it. Do not do it. Get rich quick. Again, that's the same thing with going YOLO. You might see some people on Instagram and all that are getting rich quick, but do not let that be you. You use more sound money principles, and you're going to use this as a tool and as a strategy to build wealth. All right, moving on. Done correctly, you'll be able to receive a steady income, exponential growth, right? If it moves in your favor, and you start scaling your positions and so on. All right, and then managing your capital and trade correctly, that even a huge move, which is thousands of pips against you, won't cause issues. So this will be in other videos that I use when I go more and more in depth in this. All right, whole life at 5% gain, which is a safe route, which is, well, not the safe route, but it's extremely safe. Then you got the Forex at 167% gain, extremely risky if risk is not managed and controlled. All right, so we got 10,000 and 10,000. All right, then we got 10,500, gains 5%. This one gains 167%, so you got 26,700 from 10,000. Then in the third year, right, or the second year, 11,025. Then we got as opposed to 71,289. Fourth year and fifth year, we got 11,576, 12,154. So from 10,000 all the way to 12,000, that's about what? A 2,154 gain, which is a little over 20%. And then over here from 10,000 all the way to 508,210, which is significant amount. What is that, like a 5,000% gain? A 5,000% gain or 50%, 50,000% gain? I can't think off the top of my head. Actually, let's put that in the calculator. So we got 508 to 10 divided by 10,000, which is right. Yeah, that's right. 5,000% gain. Well, over 5,000% gain. All right. This is if interest rates stay the same and margins don't change. Sometimes margins change because how my broker does it is volatility does increase excessive amount. They'll increase the margin requirement and to ensure people are not going too crazy and trying to go YOLO on this thing, because there are a lot of people that play the volatility and short-term trade. Right? Interest rates, what I'm talking about, is based off inflation or market conditions and so on. The central banks will determine what interest rates are. For instance, the Fed has been increasing interest rates continuously since the end of 2021, and still possibly they're going to increase interest rates. So interest rates increase for the HUF and decrease for the euro, that's good. Then interest rates decrease for the HUF and increase for the euro, then that's no bueno. But I think interest rates on the Hungarian forint is fairly high. All right, I'm digressing. So moving on. All right, the euro again. The euro, right, which is the European Union uses, or the Eurozone uses, against the Hungarian forint, which is Hungary's currency, is highly volatile. I mean, this thing can move thousands of pips. A minute, it can be at 390 and move to 400 pretty quickly. All right, so you got to be cognizant about trading this pair. So, what is a better way? Okay, so we got a whole life, which we got 10,000, and then we borrow from it and we put it into 10. Of course, you only could borrow a certain amount. You can't borrow the whole thing, so you got to have more than 10,000 in your whole life to be able to borrow 10,000. Right, but you borrow from it, it's used as collateral, and then you put it into your Forex account. And then from here, right, you make that 167%. You move over 10,000 into your whole life. Now you're building that up, keeping it safe, and then you're using the market's money now. Now you don't really got to have an issue with if you lose all that money on the right side. Don't lose it. Be a good steward of money, but you can stress less because now it's not your money you're using. Right, moving on. Now we move another 16,000. We move only 10,000 that time, so we can have money in there. So price can move so it doesn't collapse the position. Right, then it goes to 33. The amount you have in there is 33,400 because you gained that 16,700. You move that over into the whole life again, so it can be safe and protected and use it for other things. And your position is a collapse and it's still gaining because it still has 16,700 in there, right? And then if you're only using a standard lot, you're only using 5,447, so price can move a decent amount. And then this is for years 3 and 4. Now look at that, 16,700, 16,700 in the third year, and then 16,700. Now you're collecting a steady stream of income, building up your whole life, and then from there you can use it for real estate and other investments. All right, you don't have to worry too much about markets moving up and down after you have pulled 10,000 from there, because now you're using the market's money. You can just think about a steady income, and it doesn't matter, right? The fluctuations, because that's all you want is the steady income. But you need to keep enough space open to allow price to move and triple the amount you're trading. Which means, right? I'll show you right now what I mean by triple the amount you're trading. I think I typed that wrong. What I mean is you want to have a 3-to-1 ratio, meaning for every trade you have, you want to have 3 times the amount open. Alright, so like I said, you have 2,500. So if you triple that, it's 10,000. So now you have a lot of margin or a lot of space or a lot of capital open for price to move. Right, that's about a $12 gain from 25. Not too shabby. Are you gonna be mad because you gained 4,380 off of only using 2,500 or using the 10,000, but only having 2,500 in actual use, which is a 43.8% gain because 4,380 divided by 10,000, which is being used in your broker because you can't use it, is a 43.8% gain, or even more than that if you only calculate it based off of 2,500. That is great. And if you can scale this and compound, even better. So you break even about 2 years, right? You're protecting your money and it's straight. So now you're protecting your money on this side, managing your risk and so on. But you're also protecting things in the whole life, because if this thing does really go sour, you're good. So all in all, good deal. So remember, no matter what strategies and tools we use, we need a sound mindset, which is the stable foundation, which we can start building our financial structure and system. So all this stuff is great, but it doesn't matter if the mindset isn't caught up with being able to utilize it without thinking that, oh, you're just going to make money very quickly. No, don't get me wrong. You can make money quickly, but you still want to have that mindset where you know how to be a good steward of money and utilize it correctly. So I don't want to say you can't make it quickly. It's just you got to know how to handle that money when it comes. And without a great mindset, you're going to be like a lot of these lottery winners. Majority of them, not all of them. There's like a couple that done pretty good with it. I think there's like a TV show or some kind of documentary on it. But like most other lottery winners, that they got it, blew it all, and they're in a worse place than they were before they even had the lottery. A lot of them even say, like, I wish I never had won the lottery. But I'm digressing. Y'all have a good one out there. Thank y'all for joining me. And until next time, talk to y'all later.